We think that, with the recent rate cuts, with a lot of the risk coming out of the markets, things like the housing market stabilising, we've upgraded our ASX target to 6,800 by end of the year, so we should see a pretty good reporting season.
How is housing market stabilising? I mean, it's dropped nationally, let's call it 10%. I think it is about 10%, 14% in Sydney, 10% in Melbourne, on average 10. And it's stabilizing only because in the last month it came back up by 0.1, 0.2% in Sydney and Melbourne each. How is that really stabilizing? I mean, I don't blame these mainstream street economists. They look at markets, including stock market, housing market, any sort of chart that they can lay their eyes upon. They'll look at it daily. Well, actually, sometimes minute by minute, obviously day traders, and then hourly, daily, weekly, monthly. So if they see 1 month a turnaround in something, they may call it a stabilization. To be honest, again, if I worked for Citi, I'd probably be saying exactly the same thing. What else are you going to say? When it hits the fan, all of them will be saying, well, we didn't see that coming. There was always a risk, but we didn't think it would go that way. And this happened, that happened, and now this is what's happening. And they'll just report what's happening at that time. And if it continues to go down, for example, by equal measure, to be fair to them, they'll probably say, well, we're probably going to see a lot more pullback before it comes back up because there are no obvious signs of revival. And this is what I think is going to happen. Another prediction is that by the end of the year, the housing market's going to somewhat recover. You wouldn't call it recover, probably up to 1%, not more than that. And then first month, so January, February 2020, my prediction is that when everybody realizes that this interest rate cutting and all this panicking and the government throwing everything at the housing will not do anything, the confidence is definitely going to tank. And to quote one of the few people I actually follow religiously and have followed religiously, this particular Martin Armstrong, for about 4 or 5 years, if you are confident that something that you're buying is going to go up, say, 20% in a year, let's be a bit more realistic. Say, if you're confident that your house is going to go up by 10% next year, you wouldn't mind paying 5, 6, 7% interest rate on your mortgage. If you don't think, if you got no confidence that your house is going to go up at all next year, 2%, 3% for your mortgage is too much, unless it is a place that you want to live in which case you really are not speculating, you're really not buying it so you can make money, i.e. and or sell it down the track anytime soon in any case. So this is why my kind of recommendation, not financial advice, is that if you really want to buy a house, do it for your family. There's no point in postponing your life. But start looking around because you may end up getting or shaving off maybe $200,000-300,000 off the purchase price on, say, $1.5 million property if you do it in the first half of next year, 2020. That's what I would be doing. That's what I'm kind of looking at. My situation is a bit more complicated, but I would be optimistic to buy something to move into and live there sometime in the first half of next year or from then on, not earlier than that. This is sugar high, what we're seeing at the moment. Back to Martin Armstrong. This is the blog I read, armstrongeconomics.com/blog. He's got multiple articles every day. I popped an email address in there, submit, and every time there's a new post, which, like I said, is about 2, 3, sometimes 4 in a day, I get an email. So I don't really have to read the news, mainstream news. I can just pretty much refer to this. He covers the whole world, and he's got this economic confidence model. And just back to where I think we're at as far as the housing. This would have been probably after the Second World War, you could call it. It was really flat. There was few ups and downs, and not so much as this latest one that's culminated in about mid 2017 in Australia in any case. So we went up there, we pulled back about 10% nationwide, and then we've gone back to what is called and termed return to normal. It's looking like we are, what did she say? Stabilizing, return to normal. That's exactly where we are, right about here. Give it another, like I said, by the end of the year, it's just going to go from halfway up there to the peak, and then the January, February, March is going to look like this. It's going to pretty much look like this, in my opinion. This is a chart you probably would have seen, which is a typical chart of a bubble bursting. That's how pretty much every bubble bursts, and none of them have gone down less than, say, 40%, which is why I think this housing is going to pull back 40+% from its peak.
We think that, with the recent rate cuts, with a lot of the risk coming out of the markets, things like the housing market stabilising.
All right, so on that housing market stabilizing, once again, if you thought that next year or next 5 years the housing is going to go flat, or say minus all up 10% in 5 years, would you borrow money? And in 5 years' time, would you even borrow money if it was 2% or 1% rate from the bank, if in 5 years' time your investment is worth 10% less than what you got it for? So all of a sudden, somehow, even that 1 or 2% mortgage looks too expensive. So it's all about confidence. If it was booming, and you know it's booming, and you know that in 5 years' time it's going to go up by 50%, you wouldn't mind borrowing from the bank at 5, 6, 7%, as I said before. Yet they will try and do everything to get you into the mortgage. Even in the falling market, they'll be cutting rates. That's exactly what they're doing. They are desperate.
Westpac, yet another of the banks, we saw ANZ and CBA last week, all cutting their fixed rates for borrowers. This space is starting to get quite competitive.
Absolutely. So we've seen, Westpac cut fixed rates across some of its products, 2 years, 3 years, around 70 basis points. And that follows on from obviously ANZ CBA. The bank's really wanting to, win back some of the market share. We've obviously seen home lending and investor lending in property slow down, really wanting to win back some of that market share.
And yes, Martin Armstrong of Armstrong Economics covers Australia sometimes separately, but pretty much daily in his market report. And this is where I got that information from. The home sales measures the changes in the number of newly constructed homes sold. So what happened last month is that it was up. The actual was up 28.8%, and then this month it's actually dropped to negative 12.4%. Now that is almost kind of expected. If you've got so much of a surge the month before, that it's going to come down harder. That the higher it goes, the lower it drops. But we can see that none of this, it's going back a couple of years here in this chart, none of it has ever fallen by 12.4%. The highest ever fall was 11.8% before that, and also in August 2016 it was minus 9.7%. So this is the highest that we can see on this chart that kind of covers about 4 years that I can see exactly. And once again, let's remember the market is quote unquote recovering. This is where they tell us we are going back up, and it's going to continue to go back up. Remember this chart. I can't stress it enough. I could be wrong. I may end up being wrong. We'll know in a year or two, or even sooner than that. But my prediction is that it's not a return to normal. It's going to continue down via capitalization and the other phases of a deflating or bursting bubble. Property being such a slow moving beast, it may not be as steep as that. It'll probably take a little bit longer. It'll be a bit less steep than that, and it will probably resemble Japan, because they're starting to talk about Australia being a new Japan. Also, the Western world is going the Japanese way, where Japanese printed so much money, A. B, they cut the interest rates to zero. They've had interest rates zero for probably decades, and it's done nothing for their economy. So we expect that somehow what Japanese have tried for decades is going to work for us. So Steve Kinn's been talking about this, and he's saying that we are turning Japanese. And once again, it looks like it's not going to help us. That'll do for this video. I got a lot more coming. Thank you for watching and take care.